Most of us just assume our money is something tangible, something the government prints on paper or mints in metal. But the reality is, well, far more surprising. Around 97% of the money circulating in our economy isn't physical cash. It's actually just digital entries in a database. Banks don't simply store our wealth. They create new money out of thin air by issuing loans. When a bank signs a loan agreement, it isn't dipping into a vault to hand over existing cash. Instead, it's issuing credit, which effectively creates new money in the same instant. This is the core of our global financial system, and we've been taught a fundamentally wrong idea of the bank as a money warehouse. Walk into any bank branch, and you'll likely see the image of a fortress. Heavy steel doors, high security vaults, and maybe a few gold bars, basically treating the bank as a secure storage box for our wealth. This is the common misconception. We assume the process is linear. You deposit money, the bank holds it, and then they lend out a portion of those deposits to someone else. In this mental model, the bank is just a middleman, a warehouse that can only distribute what it has already taken in. This perspective is often linked to an outdated idea of fractional reserve banking, where the bank must wait for a deposit before it can create a new loan. But the reality is far less physical. The bank does not need to wait for your money to arrive in a vault before it can act. Here is where the illusion begins. To understand how this works, let's look at the mechanism that most textbooks describe. This is what we call fractional reserve banking. In this system, commercial banks are permitted to lend out much of their cash deposits, keeping only a small fraction as reserves. If we lived in a 100% reserve system, the bank would simply be a warehouse. But the fractional reserve model is actually incomplete and often misleading. Let's take the United States as an example. In the past, the law required a certain amount of deposits to be held as a required reserve. For instance, if the required reserve ratio was 10%, for every $100 deposited, the bank had to keep $10 in the vault. The remaining $90 are called excess reserves. Banks are free to loan out these excess reserves to anyone who comes in for a loan. Now, you might think this is where the money is created, but remember, the bank doesn't actually move those excess reserves from the vault to the borrower's hand. This is the point where the illusion starts to shift. Let's look at the actual mechanics of a transaction. If you take cash from your pocket and deposit it into a bank, you might think you've shifted the money's location, but you haven't actually changed the overall money supply. This is because both the cash in your pocket and the demand deposits inside banks are already counted as part of the money supply. It's a zero-sum movement. One form of money simply transforms into another, but the total amount of currency circulating in the economy remains exactly the same. The real shift occurs when the bank stops acting as a warehouse and starts acting as a creator. When a loan is approved, the bank doesn't move money from one customer's account to another. Instead, it simply updates a ledger. It adds a credit to the borrower's account and a corresponding debit to the bank's assets. This is the moment of creation. The money is created by a keystroke, created by a promise to pay back with interest. To quantify this process, economists use a tool called the money multiplier. The formula is simple. It's calculated as 1 divided by the reserve ratio. For instance, if the reserve ratio is 10%, the multiplier is 10. This means an initial deposit of $100 can create $900 of new money. The math works because the bank takes that first loan of $90 and multiplies it by 10. Now, consider a different scenario, where the reserve requirement is 20% and $500 is deposited. In this case, the money multiplier is 5. The bank holds $100 in required reserves and loans out $400 in excess reserves. When you multiply that $400 by 5, the total increase in the money supply is $2,000. To put this in perspective, it's like a single seed, which, through a series of loans and deposits, grows into a forest of digital numbers. It's a geometric progression of credit, where a single deposit ripples through the system, expanding the money supply based on the reserve ratio. Now, we need to shift our focus to the source of the machinery, the central bank. You might think that the money banks lend you comes from other customers' deposits, but that is not the case. Reserves are provided by the central bank for commercial banks, not from your deposits. These are not the ordinary dollars you see in your app. Instead, reserves are special money used by banks to pay each other. Think of them as digital balances used only by banks and the central bank to settle payments. For example, the Bank of England uses central bank reserves to settle net amounts between commercial banks. This is where the central bank actually injects liquidity into the economy. When the Federal Reserve buys bonds, the entire amount put into the system is considered new money. The impact is magnified by the reserve system. If the Fed buys $500 worth of bonds with a 20% reserve ratio, the new money created is $2,500. That is 5 times the original amount. This is the primary way the central bank controls the flow of money in the financial system. Everything we just discussed regarding reserve ratios is now largely a relic of the textbook. In many countries, including the United States, the reserve requirement is now 0%. This means the traditional requirement for banks to keep a slice of their deposits as a backup is gone. The system has moved beyond the fractional reserve model described in the textbooks. We are no longer talking about a 10% or 20% reserve ratio that limits how much a bank can lend. Instead, the bank's ability to create money is no longer constrained by a physical or legal reserve requirement. The ledger is the only limit. If banks can simply type numbers into a ledger, you might wonder why they don't just create an infinite amount of money. Well, not exactly. Let me rephrase that. They can't create unlimited money because they need enough cash and reserves to handle customer actions. They aren't just managing numbers. They have to be ready for the physical reality of withdrawals and transfers to other banks. Consider what happens when a borrower actually wants to touch their money. When a borrower withdraws cash, the bank must use its vault cash to fulfill that request. It's a physical limit. Similarly, if that borrower decides to move their funds elsewhere, the digital magic stops at the bank's door. When a borrower transfers money to another bank, the bank must send reserves to the central bank to settle the debt. Because of this, the real limits on modern lending are capital and liquidity. While reserves handle the daily flow, capital, which is the bank's own money from owners and shareholders, acts as the safety net. This is critical because banks use their own capital to cover losses from unpaid loans. If too many borrowers stop by paying, the bank's own money vanishes first, not the deposits. This digital creation process isn't a charity, it's a business. Banks earn profit from loan interest, which is the primary way they make their money, but they don't just wait for borrowers to come to them. To maximize their returns, banks buy safe assets like government bonds to earn extra profit on the funds they aren't currently lending out. This is where the risk enters the equation. When a loan is issued, the bank is essentially betting on the borrower's ability to pay. If a borrower cannot repay a loan, the bank loses the amount spent by the borrower. Since the money was created via keystroke and not taken from a vault, that loss doesn't vanish into thin air. It has a real cost. This loss must be covered by the bank's capital, cash, or reserves, meaning the bank's own financial health is directly tied to the quality of the loans it creates. This money creation system exists because modern economies need credit to grow faster. It is the engine that allows businesses to expand, people to buy homes with mortgages, and governments to borrow for infrastructure. But this power comes with a structural vulnerability. When banks push too far, excessive lending can lead to the formation of bubbles in the housing or financial markets. The danger isn't in the credit itself, but in the scale. When the digital numbers typed into accounts far exceed the actual value of the assets they fund, the system becomes fragile, turning a tool for growth into a catalyst for a crash. This entire digital ledger system relies on a single, fragile assumption that not everyone will ask for their money back at the same time. When this assumption fails, we hit a bank run. A bank run occurs when many customers attempt to withdraw their money simultaneously, and the bank cannot pay them because they do not hold all deposits in cash on hand. Essentially, the bank cannot meet the demand to withdraw or transfer money. History shows us that this can trigger a disaster. A chain reaction of bank runs can crash the entire economy, as seen in the US during the Great Depression. To stop this, the United States uses deposit insurance to prevent bank runs by guaranteeing the safety of funds. In extreme cases, when the panic becomes uncontrollable and the central bank cannot stabilize the lender of last resort, governments may declare a bank holiday to prevent panic withdrawals. This is the only way to freeze the system before it collapses entirely. We've seen that the bank is not a warehouse, but a creator. The money we spend every day is largely a digital promise, a keystroke that expands the economy. While this system allows for rapid growth and investment, it is built on a temporary equilibrium of trust. The core paradox is that the banking system creates money from thin air, but must eventually reconcile the rest of the world with physical reality. When trust in the digital ledger disappears, the rest of the world is forced to see the vault as empty. This leads us to a final, unresolved question. As we move toward completely digital currencies and central bank digital currencies, will this fragile balance of trust be easier to manage, or will it make the system even more prone to a single systemic failure?